Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Okay, imagine this. Your CFO walks in Monday morning, announces the company's launching its own venture fund, investing in startups. Suddenly, your tried and true FP&A models, they feel kind of broken, right? You're not just forecasting stable internal cash flows anymore. Now you're managing a portfolio of high-risk, potentially high-reward equity stakes. So today we are diving deep into corporate venture capital, or CVC. We want to unpack what this really is, how it's radically different from your classic M&A playbook. And probably most importantly for you listening, what specific, maybe novel financial frameworks you need to get your head around, like immediately, to handle this new world.
Yeah, this shift is huge. You see large established companies spinning up these dedicated CVC arms all over the place. And for you, the finance professional, the real kicker, the fundamental challenge is figuring out how you even define success here. Because a CVC investment, it isn't pure R&D spending, and it's definitely not traditional M&A. It's this hybrid beast.
Okay, let's pin down a definition first. So CVC is what? The practice of directly investing corporate money.
Exactly, corporate funds.
Specifically taking a minority stake, right? Not buying the whole thing.
Right, a minority stake in external startup companies.
Okay.
And that minority stake piece, that's where the real tension lies. Because CVC, it almost always involves this dual motive. It's got two jobs to do. It has to deliver on the strategic side. That's the why us question. Usually it's about future innovation, getting into new markets, that kind of thing. But it also has to satisfy the financial side, the what's the return question.
Yeah.
If you only chase one of those, the whole CVC program tends to fall apart.
Right. So it's not just let's make some money, and it's not just let's learn something. It has to be both.
Precisely.
Okay, let's dig into that strategic logic then.
Yeah.
Why would a big company choose CVC instead of, the usual routes like M&A or just beefing up their own R&D labs?
Well, the sources we looked at really point to CVC being fundamentally about buying optionality and also managing the sheer speed of innovation happening outside the company walls. Let's face it, internal R&D can be slow sometimes, maybe a bit siloed, culturally limited even.
Yeah.
CVC lets companies scout externally for genuinely disruptive stuff, new business models, breakthrough tech.
So the investment itself is almost like buying an option on a future acquisition. You get a foot in the door early.
That's a great way to put it. Securing early access, seeing technologies and markets develop up close, it builds this flexible footprint for potential M&A down the road. Now, contrast that with traditional M&A. Big difference.
Yeah, how does it stack up?
With M&A, you're buying control, right?
Yeah.
Often 100%. Then you got the massive task of integrating operations, merging the balance sheets, chasing those synergy-driven cash flows. Pretty much from day one, it's heavy, it's expensive. Operationally, it's incredibly intensive.
And CVC often gets pitched as the lightweight alternative. Let the startup stay independent and keep that entrepreneurial fire alive. But is it really lightweight for the finance team? I mean, you're still doing serious due diligence, right? You're monitoring the investment, and now you're modeling equity stakes with huge uncertainty.
That's such a crucial distinction. Yes, the operational load on the core business, much lighter with CVC generally, but the modeling and governance burden on finance, that can be really intense. You take a minority stake, sure, but now you're modeling a financial asset where, frankly, total loss is a very real scenario. CVC forces finance teams to think about investments that sit awkwardly between a standard strategic project and a pure venture capital asset. You have to build new modeling muscle, basically.
Which leads us perfectly into talking about success metrics. Because if your company is doing CVC, you probably can't just slap an IRR target on it and call it a day, right? So much of the value is meant to be strategic. So how do major companies handle this? How are they tracking success beyond just the final capital gain, if there even is one?
Yeah, you see some really distinct playbooks emerging. One big theme is what you could call ecosystem expansion. This is where the success of the CVC investment is fundamentally tied back to growing the parent company's own platform or core business revenue.
Okay, can you give us some concrete examples? Who's doing that well?
Sure. Think about Salesforce Ventures. They're investing heavily in cloud and AI startups, but specifically ones that integrate tightly with the main Salesforce platform. Now, they definitely track the financial return, don't get me wrong, but a key measure of success is also the partnership ARR uplift. How much additional recurring revenue is that integration driving for Salesforce itself?
Ah, okay. So it's an indirect financial metric. It's less about the return on the slice they own and more about using that investment to make the whole parent company pie bigger.
Exactly. You see the same logic with the Amazon Alexa fund. Success there is often measured by how much the investment increases Alexa integration, which then hopefully fuels downstream sales of Amazon hardware or services. Or look at Microsoft's M12 ventures. They explicitly evaluate the halo effect on Azure adoption. Do their portfolio companies drive more cloud usage or help close enterprise deals for Microsoft? That's a key metric.
But hang on. That sounds like an attribution nightmare. If Azure adoption spikes after an M12 investment, how do you prove it was the investment that did it and not, Microsoft's gigantic sales force or a million other factors? That must keep finance teams up at night.
Oh, it's the critical challenge. Finance absolutely has to work hand in glove with the CVC team to try and establish credible causal links. It's not easy. It means tracking data that traditional FP&A probably never looked at before, things like platform usage data from the startup, joint co-selling metrics, tracing leads directly generated. You can't just rely on correlation. You need defined strategic KPIs and a plausible story connecting the investment to that strategic outcome.
Okay, that makes sense. So that's the ecosystem play. What about companies using CVC more for, say, pure innovation scouting or hedging risk, keeping an eye on the bleeding edge to protect their core business?
Right, that's another major playbook. This brings us to players like Intel Capital. They've been in this game since, 1991? A long time. They explicitly use minority stakes to hedge innovation risk, to get early access to emerging tech that could be crucial for their semiconductor roadmap down the line. It's about creating future M&A options, placing bets in areas where maybe their internal R&D can't move fast enough or isn't focused.
And you see this in other established industries too, right? Manufacturing, healthcare maybe, where R&D cycles are long and incredibly expensive.
Absolutely. BMW i Ventures is a fascinating example in the mobility space. Their investments help de-risk the innovation pipeline, think battery technology, autonomous driving components. And here's the interesting part for finance. They model returns, not just from potential financial exits, but also, critically, from projected operational cost savings. For instance, getting early access to a new battery tech via an investment might help BMW build more efficient future supply chains. That saving gets factored in.
Okay, so the return isn't just about the exit value years down the line. It's potentially baked into future R&D savings or operational efficiency gains for the parent company. The payback starts earlier, just indirectly.
Precisely. And you see a similar pattern in healthcare. Look at Johnson & Johnson's JGDC. Their CVC arm often acts almost like an embedded R&D outsourcing strategy. They invest to get early eyes on breakthrough therapies or medical devices. This ultimately helps them lower the long-term cost of acquiring major new assets later on because they've already screened, vetted, and de-risked promising candidates through CVC.
And then there's maybe a third category, like Google Ventures, now just GV within Alphabet. They seem to operate more independently, almost like a traditional VC, but still with some strategic link.
Yeah, GV represents more of a portfolio approach.
Yeah.
They definitely manage a large portfolio with a strong focus on financial ROI, very much embracing the classic VC model where one or two massive home runs pay for all the strikeouts. But they also track strategic alignment with Alphabet's broader ecosystem. So it's kind of a hybrid between the pure financial focus and the strategic plays we just discussed.
Okay, this variety of approaches really highlights the challenge for the traditional corporate finance pro, doesn't it? When your company starts acting like a VC, you need this weird blend of startup investment thinking and the rigor of corporate finance. It sounds like walking a tightrope.
It absolutely is. And it demands a new toolkit. The sources we reviewed lay out roughly 6 practical frameworks or capabilities that finance teams really need to build to manage this high-variance asset class effectively and generate those long-term returns.
All right, let's walk through that toolkit. What's the starting point? The North Star.
Framework number 1, define clear strategic objectives. This sounds obvious, but it's critical. Your financial modeling must link directly back to whatever the stated strategic goal of the CVC program is. If the goal is, say, new market entry, then your models need metrics that track progress on market penetration via those startups. If the goal is building an acquisition pipeline, you need to track the funnel of viable candidates emerging from the portfolio. You can't just say, we're investing strategically without having a quantifiable strategic target attached.
Okay, makes sense. Framework 2 must tackle the messy reality of startup financials, right? They don't follow nice, predictable corporate cash flow curves.
That's framework 2. Build a flexible return model. Corporate finance folks are trained on relatively stable, predictable cash flows. Forget that here. You absolutely must use rigorous scenario modeling. Think. A downside case, which, let's be honest, is often a 100% write-off. A baseline case may be holding the minority stake for years with little change, and then a significant upside case, a big IPO or a major acquisition exit. This forces you to budget for failure, which is a concept that can make a traditional FP&A director feel, well, pretty uncomfortable.
Oh, yeah, I can imagine the anxiety of explaining an 80% failure rate on individual deals to the audit committee. Okay, and Framework 3 gets into the nuts and bolts of the deals themselves.
Right. Framework 3, align capital structure and timing. CVC deals often involve more complex instruments than just plain equity. You might see convertible notes, loans that can convert to stock later warrants, different share classes, anti-dilution rights. Finance needs to be able to model the impact of future dilution, understand the likely exit horizon, which is typically long, think 5-7 years minimum, often longer, and, crucially, model the potential integration costs if the company later decides to exercise its option and acquire the startup outright.
Got it. So we talked about the dual motive, strategic and financial. Framework 4 has to bring those together in the metrics, yes?
Precisely. Framework 4. Monitor both financial and strategic KPIs. The financial KPIs are the ones we know. IRR, cash-on-cash return, multiple on invested capital, MOIC, standard stuff. But, and this is key, you have to put equal weight on tracking those strategic KPIs we talked about. Things like the number of portfolio companies successfully integrating with the parent's platform, the rate of adoption of a key technology sourced via CVC, the depth and quality of the acquisition candidate funnel generated. If you only track the financial KPIs, the CVC program risks just looking like a poorly performing part of the treasury portfolio, missing the whole strategic point.
Okay. And if we accept that most individual CVC bets will likely fail, Framework 5 must be all about managing that risk at the portfolio level. Governance.
That's spot on. Framework 5. Governance and risk controls. You cannot treat the CVC operation like just another departmental project budget. It needs to be managed like a specialized fund. That means diversification across different industry sectors, stages of startups. It means setting clear guardrails like maybe a maximum ownership percentage, say 20%, in any single company. And critically, capping the total exposure of the CVC portfolio relative to the overall corporate balance sheet. The governance structure has to explicitly acknowledge and actively manage for that high probability of individual investment failures. You need to be able to justify the inevitable write-offs by pointing to the portfolio's overall strategic value and the potential for those few big wins.
And finally, Framework 6 brings it all back home to actually getting the money back or realizing the value somehow.
Yep. Framework 6. Exit planning and realization. For the finance team to ultimately demonstrate value, you have to model how that value will eventually be realized right from the beginning of the investment. Unlike traditional M&A, which ideally results in immediate operating cash flows coming onto your P&L, CVC value realization typically relies on classic VC-style exits. We're talking an IPO of the startup, an acquisition of the startup by a different company, or maybe an acquisition by the parent company itself. These are the main paths to getting a financial return, and their likelihood and potential timing have to be part of the initial modeling and ongoing monitoring.
Wow, okay. This really is a fundamental shift, isn't it? Finance teams and companies doing CVC are essentially blending the fast-paced, ambiguous world of venture capital with the rigorous, longer-term discipline of corporate finance. It sounds like it demands a whole new level of communication and collaboration internally that maybe wasn't needed before.
I think that's a great way to synthesize it. CVC is this unique hybrid investment. It demands a decision-making framework that's specifically calibrated for higher risk, much longer time horizons, and the value of optionality. It requires new ways of modeling, new kinds of metrics. The biggest mistake is treating it like just another standard capital project. It's not.
So for you listening, if you're the finance professional in this situation, this really feels like a moment where you can elevate your strategic contribution, doesn't it? You almost have to become the translator, bridging that gap between the innovation folks dreaming big and the traditional financial gatekeepers demanding rigor. You need to articulate why a specific startup investment makes sense, both for the business model, the strategic story, and for investor discipline, the hard financial logic.
Absolutely. And maybe a final thought to leave folks with. If your company is moving into the CVC space, you're really not just forecasting next quarter's operating margin anymore. You're helping manage a seedbed of potential future growth, maybe even entirely new business lines years down the road. So the provocative question is, what specialized organizational structures, things like data tracking capabilities, dedicated CVC teams, clear decision-making authority, What do you need to start building today to effectively manage that fundamental ambiguity tomorrow?
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.